What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 19th of 2021. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to cut straight to the chase and talk about something that I know everyone is buzzing about at the moment, and that is the supposed death cross of Bitcoin, or the crossing of the 50-day moving average against the 200-day moving average. A lot of people point to the historic significance of this being a clear bear market indicator, but I want to spend some time to not only play devil's advocate and showcase what I think is a very important opinion that sheds some light on the nuance of this cycle versus other cycles, and why I think that whether it be the headlines or the general crypto ecosystem during a bear market, how we can get a little bit caught in a siloed mentality simply because the headlines are telling us to get fearful of something. All right, so we're going to be diving into this today. I think it's an analysis you guys are going to love right after our quick sponsor. And our sponsor for today's video is Nervos. The Nervos network is an open source public blockchain ecosystem and collection of protocols, creating the foundation for a universal internet-like public network. And they've come out with some major announcements as of recent. They recently announced the integration into the Opera browser wallet, which can be used by up to 380 million people across the globe. They've even launched large-scale partnership initiatives, such as their $50 million blockchain ecosystem fund with CMBI and their smart contract security and bridge initiative with Cardano that just was announced recently. For more information, check out the link in the description below and learn more about Nervos today. Alrighty, everyone, so let's go ahead and dive straight into this conversation. So first off, I want to go ahead and provide a bit of context and explain why I understand very clearly that the death cross, or the crossing of the 50-day moving average against the 200-day, can be seen as a bearish event, right? So just to kind of detail what this is, as you guys can see on my chart, I've got this blue line here and this red line. Now, the thing is, these two moving averages are very significant. If you're talking about kind of TA 101 or most traders out there, a lot of them are going to be using moving averages. Moving averages generally put are basically averages of a given time frame to a certain variable. So that's a very technical way of saying it, but basically when this blue line is moving somewhere, so at the end of this tail line here, it is the last 50 days of closing price action averaged out and divided by 50, right? So it gives us a good indicator over time of where momentum's going. If Bitcoin is generally going down over the last 50 days, the 50-day moving average is probably going to start to decline, right? And then also here as well with the red line, this is the 200-day moving average. It's averaging the closing price of the last 200 days with a price and giving it a nice solid value here that slowly moves up or down over time. Well, we can see very clearly here that we've got the 50-day coming down very close to crossing the 200-day. And this generally does signal that over the last 200 days, price on average was higher than it's been on the last 50 days. And this is coming because of the fact that really over the last 50 days, generally speaking, or more, we've started to actually stagnate and go down in price. And that's why it's called a death cross, because when the longer term time frames are outpacing the shorter term time frames, that means that the momentum is dying in the markets. That's generally why it's called a death cross, right? So you've got this potentially fatal fate for Bitcoin now that the 50 days crossed the 200-day. And to be completely fair, I'm going to be completely candid and just go ahead and state the obvious here that everyone's very concerned about. We usually generally only get death crosses when we're well into the beginning phases of a bear market, right? We only had one here, for example, back here in March of 2018 when we were months into the last bear market, and then of course prices continued to decline afterwards. We also had a death cross here, for example, back in April 2014, again, well into the bear market for a couple months and then continuing to drag lower after. And then we also had one back here where Bitcoin crossed through. And again, we still had a continuation here from 2011 down here to the end of the year, right? Again, well into the bear market. But I want to go ahead and talk about, and again, this is something that I emphasize a lot here on the channel, and that is not getting siloed into your train of thought simply because you found some kind of consistency in the market, all right? We want to use a variety of variables in the market when we're analyzing things, but not to mention as well, we don't want to get siloed in just analyzing one way an indicator can give us signals or an idea of what the market's going to do. And I want to go ahead and focus on something here. I don't want to talk about so much how the 50-day could cross through the 200-day and focus on this death cross. What I'd really actually like to talk about here is the same way of viewing the 50 and 200-day in a different way. Notice how in each of these bull markets, when we talk about bottom to top here, right, really getting out of the accumulation channel and going up towards our new all-time highs, you notice how there really isn't any crossing of the 50-day against the 200-day. We can see here beautifully stayed well above and stayed well spaced above the 200-day, right? Even coming close here, still never going below there, right? Until we went all the way up here towards 1200 at the peak. All right, let's take a look at the next cycle here, right? After we got out of the accumulation phase, 50-day stays well above the 200-day throughout the entire 2017 cycle until we have that cross well into the bear market, right? Let's take a look at our most recent cycle here. Ooh, something's different here. You know, if you were to talk to any TA expert in this case, they would tell you that this was not a bear market, right? This was a mid-cycle consolidation period. We were still generally, some would even say we're not even in a bull market just yet, that we were still escaping back to the previous all-time highs, and that this would be considered a bear market or a bull market. But let's put the terminology aside. This looks a lot different than the previous cycles. There was a lot more consistency to the 50-day staying above the 200-day after we exited out of the real, accumulation consolidation period here, right? You can see back here as well, right? Once we had gotten out of this kind of neutral period, this is in line practically with the bottom here in the market, we just continued cleanly with the 50-day staying above the 200-day, that momentum consistently being maintained. So what was different this time around? Well, if we take a look at where the cross happens and what happened afterwards, we had a massive, fast-paced recovery in Bitcoin's price versus previous cycles, right? Not as big of a deviation this time around, right? How about back here, right? We got the cross back here. It was a slow deviation away, slowly but steadily, right? Now, of course, we can't work with this back here in the 2010 cycle because the 200-day, there wasn't 200 days worth of price action, right? But what we saw here in this cycle was a fast breakaway from the lows. We went from nearly $3,100 up to nearly $14K for Bitcoin. This was, bear in mind, the second fastest recovery off the lows we've ever seen in history. And we're generally working with what many people think are expanding cycles. Cycles are supposed to get longer and they're supposed to have lower multiples than the previous cycle. That's kind of a given, right? That markets aren't going to be able to multiply as much from a $1 billion, or they're not going to be able to multiply as much from a $1 trillion valuation versus a $1 billion valuation, right? It's easier to double at a $1 billion valuation versus a $1 trillion valuation. So my key point here that I want to emphasize is that there's a lot of chop here between this indicator that everyone's focusing on, right? And it wouldn't be a surprise if we're going to have the same up here, that we might have a sideways consolidation period where after the death cross, we really just basically get these things crossing one another time and time again until we get more of a consistent trend, basically meaning that the worst is behind us. Now, why would I be so confident of that? Why is it, first off, that we had this massive breakaway and we needed to stagnate for a while in order to compensate and go back to where we should have been? So where we should have been to the stock flow model, to a lot of the other data science models. Well, the reason is because there's something fundamentally different this time around from how the market traded back in the day. Up until 2017, as far back as 2010, when markets barely started to formulate around crypto, we had spot markets. Spot exchanges that you're probably very familiar using, such as Coinbase, Binance, Bittrex, Poloniex, back in the day, Bitflyer in Japan. There weren't many exchanges out there, but at least the ones that were out there, they were liquid exchanges and they were spot exchanges, the ones where you're trading actual Bitcoin and actual Ethereum and other digital assets for cash or stable coins. Real price discovery. Unlike in today's market, where the vast majority of volume traded is in derivatives, in futures contracts, in perpetual contracts, in all types of ways that you can garner exposure to leverage. And what you have now is a problematic scenario. You also have platforms where people are borrowing, physical crypto in this case, and they're going out and trading on leverage physically through borrowing platforms. So you have all this leverage and credit in the market, this borrowed capital that is both driving up markets and also dragging markets down. Whenever we get long liquidations, right? These big, huge amounts of people who lose everything on their underlying positions because there was a sell-off in the market, and it caused a domino effect where they had a margin call and then a liquidation and therefore lose everything. And it doesn't just mean that they lose everything, because the exchanges themselves, as well as the borrowing platforms that people borrow the capital from, they have to cover for their depositors that are earning yield, providing you that capital to go speculate. And that basically causes the dramatic drawdowns. And I can go ahead and show you what this kind of looks like, guys, if you want to take a look at it. What I'll do is I'll turn off our indicator here and just take a good look here. We'll have to go over to one where we can get intraday price action. Let's go ahead and dive into the 4-hour chart here, right? And scroll back to the sell-off. You can see that this is where major capitulation happened. I'll turn off the volume so you guys can see that candle well. This is an example of a capitulation candle, right? And it's not people just purely panic selling, right? It's a lot of the time, this being the real majority of the selling here, and it being over exaggerated, and nearly in this case by $10,000, because the exchanges and the platforms themselves have to cover the depositors who initially lent out the capital for these people to speculate on margin. What they have to do is they have to sell the collateral of the borrower, people who usually locked up crypto positions. They need to sell that on the market, and it causes a domino effect where prices just keep going down and down, and more liquidations happen until you get a buyer or a set of buyers who come in and save the market and buy the dip, right? We can see here, though, that this was why, to a very large degree, you could even say possibly these candles here were part of that capitulation. It's a very short time frame and a lot of sell side price action, where again margin trading has distorted the market. And the important thing to realize as well is that because of margin trading, a lot of people got liquidated and lost everything, which means that in this case they don't have probably a likely I would say they're not inclined to re-enter the market so soon. They just lost everything in a lot of occurrences, right? Some people have a leverage position that's 20x leverage and they get liquidated, and it's not the end of the world. It's 10% of their portfolio. But for many people, let's be honest with ourselves, it's everything. It's people doing 2 or 3x leverage at the peak of the market and thinking, oh, I can't be touched. It's only 2 or 3x leverage. I'm never going to get liquidated. But they do. It happens time and time again. And it has led to both upswings because people can get liquidated being short. That's what all these nice little red boxes are, right? And then they can also get liquidated as longs, right? Now, there is a long bias here to the market, but at the end of the day, you're still going to get short squeezes that are going to push prices up higher than where they should be. Perhaps we had that past 20K going all the way to 65K in a very short period of time, in just a matter of 4 to 5 months. And it's also why we have these dramatic sell-offs in the market. Don't you think that that's going to disorient the 50 and 200 day? We've already seen it happen. We saw it happen for a couple months. So my point here, guys, is that, look, could we see maybe a little bit more downside? Possibly. But I really don't think at this point, well, first off, generally speaking, that when you've gone to this point here, where you're talking about the 50-day cross the 200-day, except for an anomaly like COVID, we really didn't go much lower, right? So again, at this point, I would consider, first off, whether it's a bear market or not, is it worth taking the taxable income profits at this range for you in your jurisdiction? But outside of that as well, is it really worth the risk of trying to speculate and trade at this point? I gotta say, if you can't learn to adapt to each and every cycle and understand the nuances of each cycle and the differences between the previous ones themselves, then you can get caught in a really bad position, getting caught 2 steps behind after an already pretty bloody sell-off in the market. Anyways, guys, I'm curious to hear what you all think about this. I don't mean to ramble on with too much confidence. I always want to keep open the idea I could be wrong on this. But again, I think it's fair in this case that if we're going to be focusing on the death crosses, we also should be focusing on the relation of the golden crosses. And what's so fascinating is that in this cycle, right, things are just fundamentally different. People have taken on too much risk. And that's why we also have these dramatic swings here on the downside. We've also had them on the upside. I can tell you all, going from 10K to 65K within a matter of 6 months, 7 months, for the size of the market, that has absolutely massive magnitudes of valuation increase. The biggest valuation increase we've seen in a single rally in Bitcoin's history by far, right? So anyways, that's it for today's video. I'm done rambling for today. If you guys like the video, please consider dropping a like, consider subscribing as always. And if you guys are interested in this kind of analysis, you can always check out the Dash report down below in the description. It's a great way to support the channel. And again, if you're interested in buying the dip, again, this might be a time where you can start to focus on building long-term positions. Even if the market continues to decline, dollar cost averaging is never a bad idea. All right, that's it for today's video, guys. Thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.